Canadian investors are digesting the federal budget. The spending plan announced Tuesday includes billions of dollars for infrastructure and new tax opportunities for businesses. Add to that a slew of earnings. We're going to get some perspective on everything that's unfolding from Lesley Marks, Chief Investment Officer at Mackenzie Investments. Lesley, thanks very much for joining us.
Good morning, Roger.
Let's get your thoughts on the budget. Is it good for the Canadian economy and Canadian business?
Well, I think it is. As it is presented, I think the real challenge now is going to be execution. And here's why I think it's positive as it's presented. I mean, first of all, encouraging business investment and shrinking the size of the government is going to be very positive for the Canadian economy. This is exactly what we need to drive the productivity gains that we haven't seen over the last decade for our economy. Secondly, providing tax incentives for businesses to be investing in the Canadian economy is also very important. You know, our Prime Minister basically stole a page out of the One Big Beautiful Act on that front. And I think that will also be very positive, and encouraging businesses to invest in capital spending or capital expenditures kind of takes a little bit of the pressure off of the government, which is generally what we want to see as investors. Smaller government and more investment and productivity coming out of Canadian companies.
Could the reduction of government been bigger, do you think?
The reduction of, well, I think, you know, I think you're talking about the size of government. Yeah. Sure, it could be. But I think, you know, Prime Minister Carney knows that it is difficult given the magnitude that he's talking about in the number of job cuts. And, you know, even though we often will see statistics about the size of government increasing, the reality is that our population has increased. So supporting a bigger population probably needs more people. But I think it is probably not lost on the government, as it is on every corporation right now, that the opportunity to do more with less with AI tools is going to be an imperative to strategy. And so I think what he sees is there's opportunity here to drive productivity even within the government, utilizing technology, more artificial intelligence, and that will be a good thing. So if there's more, and if they can do more, that would be great. But I think it's still a pretty ambitious plan as it's laid out. So we're focused on execution.
Okay, and he spoke just about a half an hour ago, and he said he hoped to bring in $1 trillion over the next 5 years, I believe, into the economy. Is that optimistic? Is that realistic?
Well, you know, you always see these numbers, and we've seen them, you know, thrown around also by President Trump. And what we never know when we see numbers in the trillions is what is included in that. Is that investment that would, you know, already have happened in the Canadian economy, or is that net new investment for the Canadian economy? Is that ambitious? I mean, anytime you hear a number with a T trillion in front of it, that does sound ambitious. But over what time period? Is that $200 billion over 5 years? Maybe that's less ambitious. So I think that those numbers are really meant to kind of create shock and awe for investors, and to sort of you know, put his stake in the ground. But I don't put a lot of weight in them for what it's worth.
Okay, I think shock and awe might be appropriate for the S&P 500 earnings season. We're about midway through. For the most part, they seem good, but
yeah, earnings have definitely come in on balance better than expected. What we have seen over the last couple of days is when companies are meeting expectations, their stock prices are not holding in, and we're seeing sell-offs. So meeting is not good enough. You have to beat expectations in order to get that next level in stock prices. And the reason for that is because we are already dealing with, you know, fairly lofty valuations overall, particularly in the more thematic names, the technology names, the AI names, communication services, et cetera. So companies need to beat to get that next level of upside in their share prices. But overall, in aggregate, we actually have seen this as an earnings season that has led to upward revisions through the end of this year.
And is that a bad thing, maybe a little more balancing of the market?
Well, I do think the market does need a little more balancing. And I think that's an interesting point. The market has become so thematic thematically oriented. And so all of the focus has been on very few names, and the breadth is not that great. And that's not really a healthy environment for stocks. What you want to see to feel really good about the future and the next move in equities is a widening out. And how that happens is when there is a broadening of earnings momentum or earnings upside that comes from a healthy economy. The issue right now is, and obviously without data, we are sort of, trying to pull the mosaic theory together to say what is actually happening in the US economy. But it does appear to be that the US economy is flatlining or slowing. And the only data we have really to focus on is labor. And it doesn't appear that companies are more optimistic and increasing their hiring plans right now. So we're in a data vacuum. We really need to see the US economy pick up, and that will increase the breadth of earnings across the S&P.
And we're almost out of time, but I want to get into about Canadian companies. They're starting to report. What are your expectations for that?
So Canadian companies report on a lagging schedule compared to the U.S. So the data we get coming out of the U.S. comes first, obviously. So we're just starting to see Canadian companies. And I think it really depends on the situation. Canadian companies that are more domestically oriented, I mean, thankfully in Canada, we're still getting economic data. And we can see that the Canadian economy is definitely struggling here. So companies that are more domestically oriented are having a harder time. On the other hand, companies in the resource space, gold specifically, have the benefit of the strong upward momentum in the gold price as a tailwind. And that's a big part of the TSX earnings. Canadian banks have also been very strong. It's been a very good environment for the banking sector in many areas, wealth management, capital markets, et cetera. So Canadian earnings actually look pretty good. And the revisions for next year are actually quite strong. It's one of the most, the highest upward revisions for 2026, which will be good for us.
Okay, and we'll leave it on that note then. Lesley, thank you very much for joining us.
Thank you.
Lesley Marks is Chief Investment Officer at Mackenzie Investments.